Hi everyone, and thank you for joining me for another episode of my series of Q&A with Wall Street investors. In this episode, I'm going to be going through the session that Sofi stock had with Wall Street analysts on January 30th. So let's get right into it. Starting with the question from Goldman Sachs, I was wondering if you could go into a little bit more detail around the origination assumptions. So Sofi is a bank that gets deposit, makes loans. This analyst wants to know about the loan originations during the quarter and for the rest of the year. And so let's get into the answer. The CFO jumps in and says, they're assuming modest growth in personal loan business. And then in student loan refinancing, we're assuming that originations are at the current levels at least through the end of August 2023. And we do expect a bit of an uptick once the student loan moratorium ends in June, followed by a 60-day extension. I have a little bit of a skepticism with this answer because of how many times the student loan moratorium has been extended. I don't know, what is it, in its fourth extension now? The administration continues to say this is the final extension. This is the final extension. This is absolutely the final extension. But they keep offering more extensions in this student loan. So I don't know how realistic it is to assume that this final one that they mentioned is going to actually be the final one. And so there's a bit of a greater degree of risk here with this assumption. And then finally, with home loan originations, we expect to continue at the current pace that we're at right now, with a potential uptick in the back half of the year. This is a bit more realistic. Home loan purchases and refinances have been significantly down since the Federal Reserve has increased interest rates. The cost of buying a home is ridiculously high. Home affordability is ridiculously low. So people are not as much interested in buying new homes or applying for, especially applying for mortgages to buy new homes, right? Investors with all cash purchases have been buying up a lot of homes. But in terms of the regular consumer going out and borrowing money to buy a home, that's way down. And then refinances is way down, right? Because interest rates are so much higher than they were. Maybe in the back half of the year that will improve if interest rates do in fact come down. That's what Sofi is expecting, although I would also assign a higher degree of risk in this regard as well. If I was forecasting, I would say that to continue forecasting for these low levels of home loan and student loan refinancing to continue to persist for the rest of 2023, rather than expecting an uptick in either of these two originations in the middle or the back half of the year. The next question comes from Oppenheimer. They're curious about how management thinks about an environment where you may need less deposits and how you would go about perhaps trimming that growth rate in that environment. Let's say originations are down. So this is an interesting question from Oppenheimer. If you've been following Sofi, you've noticed that the customer deposits are way up. They've attracted billions of dollars in customer deposits, especially after they got their bank charter, and because they're offering a very attractive interest rate on checking accounts and savings account. So if you're a customer, you're thinking about leaving your money at Bank of America or Sofi, Sofi offers you a really high interest rate, right? Way higher than Bank of America. I think at last Sofi was at 3.75%, and checking account at Bank of America is 0%. Savings account, I don't know if it's much higher than that. But so if you're thinking about switching, it's really annoying to switch your bank accounts, right? You got to change a lot of customer information. You got to go to your job, fill out a bunch of paperwork for the direct deposit. It's a big hassle, right? Time consuming. So you're not going to do that unless you're getting a significant advantage from switching. And so Sofi offering this attractive interest rate is to attract these deposits. But Oppenheimer is saying, hey, wait a second, if you're not going to be making a lot of loans, why would you want to pay to attract these customer deposits, right? You're going to be paying to get all this money, and then if you don't have loan demand, in the customer groups that you want to lend to, right? There's always people that want to borrow money, but as a bank, those might not be the people that you want to lend to. And so if you don't have sufficient prudent customers to lend to, it's just costing you money to have those monies in your account. So that's what the analyst wants to know. How long are you going to keep offering this attractive rate that's bringing in all of these deposits that you're having to pay customers if you're not going to be able to lend that money out and earn a spread on what it costs you for the money and what you earn in that money? So really good question here. I'm curious to see. And, I've already gone through this report, obviously. And so I'm curious to talk about what management responded to that. So the CEO first jumps in that, yes, we've got more deposits, and it reflects the strategy that we've employed behind the bank to offer a very high interest rate on checking of over 2% and a very high interest rate on savings at 3.75% with no fees. So comparatively, offering way better terms to attract customer deposits, right? And that's bringing over deposits from other banks. He goes on to say, what I'd say is we're nowhere close to the point where our total deposits that we would have trouble deploying them. In other words, they've got enough customer demand for loans to more than cover all of the deposits they have. So there is no issue with shortage on the demand side for loan originations. So they're nowhere near that point. So that's not an issue right now, which is good news. There are several businesses that we're not in today that would leverage deposits, including small and medium business loans, and being in that entire sector would require deposits as well. So the CEO saying, even if we were to approach that point, then we could enter into this entirely new market that we're not even in yet, because we know that it would require significant more customer deposits to enter into this new market. So overall, not at that point yet and nowhere near that point. However, if in my opinion, I would prefer that management was a bit more conservative in terms of discussing what they would do if they were nearing that point, instead of discussing, oh, well, if we ever reach that point, we'll just go into a new market, acting like, oh, it's no big deal. We can do this thing that we haven't done before, because it's probably like what we've done before. I think that's underestimating the difficulty of entering a new market with new competitors, with new market share dynamics, in not knowing how your competitors are going to respond to that, right? Maybe right now, Bank of America, JP Morgan, Citigroup are not responding to you offering very high deposit rates to steal customer deposits away from them. Are they going to take that same passive approach when you try to enter the small business and medium business loan market? How can you be sure that they're going to let you enter that market without a response that will hurt your business? What if they say, you know what, Sofi, you're getting ahead of yourself. We've let you come this far without responding to your moves to take market share, and we've had enough of that. So we're increasing our savings rate, we're increasing our checking account rate, and so you will no longer take our customer deposits. And by the way, we're going to start offering lower rates to our small business loan customers, and really meaningfully hurt SoFi's growth expectations, right? Because these other banks, Bank of America, JP Morgan, Citigroup, they're much larger, much deeper pockets, bigger resources, more experience in serving these markets, longer history with customers. And so right now, they've kind of taken a passive approach to SoFi's growth. I wouldn't be so confident if I was management that, oh yeah, we'll just enter into this new market. All right. So really interesting questions by analysts here, and management's responses really gave me some insight into their thinking process and how they'll respond to market dynamics. I hope you've gained some insight from this Q&A session. I always find these incredibly insightful. It gives me more visibility into what management is thinking, and how they're going to respond to different conditions in the market. So that's all I've got for this video. I'll see you next time in another installment with Q&A with Wall Street. Thanks for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.